Welcome back, the man, the myth, the legend, Steve Cress. Always great to have you on Investing Experts. Always great to talk to you. Welcome back to the show, first of all.
Thank you so much for having me. Always a pleasure to be here and truly appreciate you organizing it. Thank you.
Thank you for making the time. We appreciate you. If I can speak for the audience as a whole, which I will. Before we get to the matter at hand, which Steve is generously going to share with us the top AI stocks for 2026 and tell us why the AI sector is worth looking at in the first place. But before he does so, I am going to very quickly read a disclaimer beginning now. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment security strategy or any product or service is appropriate or suitable for you. Based on your investment objectives and personal and financial situation, this presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents Steve's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed security dealer, broker, U.S. investment advisor, or investment bank. Steve, please share with
Rita, can you repeat that?
Can you hear me now?
Just kidding.
A little slower for those in the back. Steve, share with our audience, if you would, please, how you're looking at the market these days, very beginning of February 2026, and what you think of this AI sector, which so many companies you could put under that umbrella, couldn't you?
Yeah, well, I think the timing of the podcast today is excellent. And I feel like I have deja vu to like almost a year ago when DeepSeek came out and the AI stocks got crushed.
It's already been
and it was the beginning of like a market decline that went from really, I guess, the end of January all the way through to April. And the market, the S&P 500 at one point, I think was off about 15%. And a lot of the stocks that we like that had strong fundamentals were off 20, 25, 30, 40%. With nothing wrong with the companies. And yeah, it just really feels like deja vu. And I will say there are a number of comments that are very attuned to what's going on that I can recall a year ago. And a lot of people actually reaching out, thanking me for basically telling them everything is okay back in March and April and take advantage of the dip. And they made a lot of money. And I feel like, of course, I don't know, tomorrow these stocks could rebound right away. It doesn't feel like we have the same type of catalyst that we necessarily had a year ago, but we did have DeepSeek, and that really was sort of a major catalyst for the tech stock selling off. Tech has been all over the place in terms of volatility since really October. AI stocks sold off a lot on overstretched valuations, and the high beta stocks, some of them sold off as well. Then they came back, then they sold off again. There's just a lot of volatility out there. We have seen a lot of volatility back and forth. Haven't seen a deep sell-off yet, but today it certainly feels like some of these stocks are getting crushed. And if you just look at the underlying fundamentals, and particularly with the companies reporting fairly good numbers, even in, some of these top semiconductor companies and chip companies have had really good results. They're getting absolutely smashed. And it's so interesting because the AI trade has really just been in place maybe like 2 years. And obviously it's going to last a lot more than 2 years as you go beyond the Magnificent Seven and into many other technology companies and many other industries and individuals who are incorporating AI into their daily lives. This is a trade that's going to last a very long time, and it's going to be very broad. It's not going to be really concentrated just to the Magnificent Seven. But it's been a really interesting market. And this slide, we call it a tale of two cities. There are broad market rallies, and then there are safe haven rallies. And, what has occurred over the last, I'd say 6 months to even more recently, we had geopolitical events, which were Greenland, Venezuela, Middle East tensions, of course, tariff threats, some of the geopolitical events that are creating the movements to the safe havens, which I just had mentioned. And what's really odd now is when we're seeing a sell-off in the safe haven sector being gold and silver. We saw that last Friday. Then it rallied back yesterday. Then it sold off again today. And the market is in like such a confused state that typically gold and silver, which fall in the materials sector, uh, materials will sell off in general, and you'll see gold and silver fall off. But today, even within the material sector, there seems to be a rotation where the sector is performing well, but not the gold and silver stocks. So those were getting crushed. So the market is in a really confused state. And then with AI, when we see the broad market rallies and the focus on the AI stocks, um, investors are beginning to learn many companies outside of the Magnificent Seven are benefiting. As I mentioned, you have manufacturing and healthcare where there's AI integration. You have individuals, who use ChatGPT to, write their emails for them. It gets very basic. Or you have many companies using it to write code where they used to have programmers. So there are tremendous efficiencies that are taking place. And of course, this has created tremendous demand on energy and the data centers as well. So there's that wave of AI adoption, and some days plays into the favor of the stocks. Some days people move out of the stocks. Mostly, what we see is usually a fear of a software provider or equipment provider introducing AI of greater efficiency, so the market gets scared, and it gets very scared because so many of the stocks are very overvalued in terms of their conventional PE ratios. And then, of course, you have what's happening with the Fed. So, um, in the back half of last year, it wasn't really the sticky inflation that moved the Fed to lower rates. It was concern about labor. And that sort of died down coming into January. So there was no rate cut in January. The talk coming out of the Fed is that the labor market seems to be okay. Inflation still seems sticky. So we're not going to get the rate cuts we want. But of course, President Trump announced his new pick for the head of the Federal Reserve, and it is likely that we will see rate cuts. So the market is just in a very confused state right now. And you know what? The people that benefit are the ones who could take advantage of the dips and find the companies with strong fundamentals. So here is continuing sort of a tale of two cities. This was actually yesterday's picture. I want to stop sharing this slide. And what I want to do is take us to another slide where we can actually look at market data. I'm on Seeking Alpha Premium right now, and we have just tremendous tools. One of the tools that I look at multiple times a day is our market data page. So if you look at the left-hand menu on the navigation bar there, you'll see market data. When you look at market data, you can look at all kinds of things. You can look at sectors, market cap, commodities, ETF strategies, bonds, cryptocurrencies, currencies, just a whole bunch of choices. Right now, I'm just looking at the sectors in general. As I explained before, even though we have gold and silver coming down, we actually have basic materials as one of the better performing sectors today. If you go towards the bottom, you can see technology is selling off quite sharply. If I were to click on commodities here, we could see today silver is actually traded up now. We do continue to see gold come off a little bit, but it's actually far off the lows from where it was earlier in the day. Other sectors within materials are energy, agriculture. So just sort of a whole host of data points and sectors and asset classes that you can look at. So I wanted to give everyone a picture there, let them know that this page exists. So often you could tie that to what's happening to the market. So I'm going to take us back to our presentation, and I just wanted you to have a fresh picture. So the market rallies, the market cools, the market comes off. As you saw, energy stocks over the course of the month, and you can look at the far right here, energy has done quite well. If we went over the course of the year, energy would not look that great of a performer. But in the last 4 weeks, it has. And it's rose obviously by just being super, super freaking cold throughout the United States. Whether you live in Florida or Maine or Minnesota or Michigan, it's been absolutely freezing. I think Greenland has actually been recording some of the coldest temperatures that they've ever had. So it's just cold all over the place. So we've seen a really big pickup in energy. Noticeably, consumer staples is the second best performing sector on the month for the last 4 weeks, I should say. And that's after lagging for the entire of 2025. It's actually having the best January in over a decade. And again, investors are sort of using this as a safe haven and a defensive sector to move into. Consumer confidence hit its lowest level since 2014. So again, a lot of mixed data points coming out. And then starting last Friday, as I mentioned, we had a huge sell-off in gold and silver as President Trump announced that the new Fed chair rallied back on Monday, then sold off again today, but it's coming back from the lows on the day. So where are we with AI and all of this? Because that's what I want to focus on today. I think there's just a tremendous opportunity. And I'm going to flip to another page. I'm going to go off the presentation. And the whole presentation today is focused on our top 10 AI stocks. And I'm going to give you a peek of that right now. So I'm going to share this tab instead. And you can see these top 10 stocks on average today are down almost 6%. And I'm actually loving this because it's just a great opportunity. These stocks have wonderful fundamentals. They have tremendous growth compared to the S&P 500. They have tremendous growth compared to the Mag 7 stocks. But you can see the majority of them are getting crushed today. You have AppLovin, Credo, you have Micron Technology, you have Hut, you have Celestica, just absolutely getting hammered. Most of these are really big market cap stocks as well that are coming off. But if you look to the far right, this is actually an earnings page in our portfolio tool. And you could see, I'm going to sort of sort it by the companies and their most recent earnings announcements. And you can see every one of these stocks, okay, going back from November to February 3rd, every single one of them beat expectations in terms of their earnings per share, and pretty handedly as well. I mean, these are some huge beats. Light came in at a 26 cent surprise to the upside. Celestica came in at a 13-cent surprise to the upside. Even General Motors, and I don't think anybody expected that came in at a 24-cent surprise to the upside, and that is one of our AI stocks. Point being, you can look at all 10 of these companies and their recent earnings, and they're absolutely crushing it. Only one company missed at the top line, that was GM, and it's minuscule. It's like $740 million, which is nothing for $1 billion revenue generator. So earnings look good, fundamentals look good, but the stocks are getting hammered. To me, whenever I see strong fundamentals, especially quarter after quarter, I know these are stocks that I want to buy on the dip.
You've answered this question I know that you've answered this question in various forms many times, but because of these, big slides, what would you say about the change in quant ratings? And also because these are picks for the year, what happens when these buys become holds, and do they become sells, and what happens then, and what does that mean, and how long is the holding, and what would you say to those questions?
So I'd say a hold means hold. It doesn't mean sell. So if you have a stock that goes from a strong buy to hold, I would not be selling it, especially right when it happens. And in fact, in our Alpha Picks product, we keep holds in there for 180 days. So I do have a lot of faith in maintaining holds, especially if the companies have good fundamentals. After 180 days, if the stock isn't doing anything and the fundamentals look like they're deteriorating or not getting any better, I'll typically say it might be time to let go of that stock. But just remember, hold does not mean sell. However, sell and strong sell, that does mean sell. So something has happened, the factors have changed, the valuation is either crazy expensive, the growth might be dropping, profitability might be getting weaker, momentum and analyst revisions could be getting marked down. And that's typically what will generate sells. So when you do see sell, that is a time to sell. And again, it's data driven. It's not like an opinion necessarily on what management is saying or an analyst is saying. It's the fundamentals of the company changing compared to its sector, and it's becoming weaker. And that is your signal to get out when you see that sell or strong sell. So hopefully that and we do get that question. So I thank you for asking that. But in AI, this does not look like a sector you should sell. This is a snapshot of the rapid adoption in this that we're seeing in this business. So the global AI market is expected to hit $3 trillion by 2033. And of course, it's being fueled currently by big tech investments and booming data center demand. But we're also seeing this broaden out to many other sectors, whether it's healthcare or legal or manufacturing. AI is taking place all over. So there is just a tremendous amount of CapEx, not only from the Mag 7 stocks, but from the broader market as a whole, and companies, as I should say, as a whole. And on the right here, you can see a chart that shows artificial intelligence market by size and its anticipated growth from a combination of services, software, and hardware. And you can see in all the categories, it's really growing. So we look at where we are now, sort of at the 2026 level. We could see it at 539 billion, and just by 2033, it's growing to over $3 trillion in terms of the market size. So it's absolutely tremendous. And like to put it in a perspective, if you think about ChatGPT, right now ChatGPT has over 1 billion monthly active users. If you look 2 years ago, it was only 200 million years ago. And if you went back 3 years ago, it wasn't even existing really, for that matter. So the level of adoption has just been absolutely tremendous. Coming over to our next slide, you can see there are a number of ETFs. Here we highlight one ETF in particular, the Global X Artificial Intelligence and Technology ETF, looking at it compared to the S&P 500. And you can see the return is almost double. And you're going to have periods like today where based on valuation fears or based on news and sentiment, the stocks have come off dramatically, far more than the S&P 500. But based on the previous chart that I showed you, that growth rate is far, far superior to the rest of the S&P 500 in terms of the size that these companies will be growing. So I think it's a bare minimum could be great to add an ETF that's focused to in artificial intelligence to your portfolio. But if you want to take a more active role, we have stocks that we're going to be highlighting as well. And this was yesterday. So this was from the Wall Street Journal. I thought it just sort of made an interesting picture. Sometimes it's worth 1,000 words. And as you can see, there are new worries about the threat posed to AI tools and software companies that sparked the slump yesterday in the technology shares. And it really intensified. The NASDAQ at one point was down about 2%. I think it finished down more than 1.5%. And of course, today it's off pretty significantly as well. And you can see over here, data provider stocks and private fund managers drop after Anthropic releases the Anthropic release, which again, that's in software and just showing a lot more efficiency than the existing software, which in terms of efficiency, it means it will have less demand on data centers and less demand on energy. So same thing that we saw a year ago on one company, DeepSeek, it threw the NASDAQ and AI stocks into a panic, but it was pretty short-lived. It was about 2 months, but it just presented an incredible buying opportunity at that time. So why do we use quant? This is sort of along the lines of the question that Rena just had in terms of holds and sells. Quant is really, it is fundamental analysis. It is the techniques that we use at Seeking Alpha are the same analysis techniques that an analyst would use at Morgan Stanley or Merrill Lynch, Goldman Sachs. We're looking at the same type of investment characteristics, which would be value, growth, and profitability. In our quant model, we actually look at additional investment characteristics. We look at momentum, and we look at analyst EPS revision. So our model is actually, it's historical looking in the data, but it's also forward looking, where we take analyst consensus estimates for revenue, EBITDA, earnings per share, and a number of other metrics as well. One of them being earnings per share, and we actually look at the quantity of analysts that are taking their numbers up on a company and the quantity that are taking it down relative to its sector. So I tend to refer to our approach really as a GARP approach, which is growth at a reasonable price. But what we're doing is, quant really uses data and math and algorithms to identify these investment opportunities within these investment characteristics. So having been an analyst myself, when you write investment research reports and you cover a sector, you can really only cover maybe 15 or 20 companies because you're literally doing it manually. You create your spreadsheets, and in the spreadsheets, you're looking at your stocks compared to the sector. Then you have to take the time and effort to write investment research reports. So if you cover about 20 stocks, maybe you could get 2 solid reports out a month and maybe sort of a monthly to update and maintain information on other stocks. But you can't really generate thorough research reports on every company every day. And what's amazing about quant is we're marrying these investment characteristics with the power of computer processing. So instead of just covering 20 companies, we can cover 5,000 stocks, and we can update and refresh the data every single day and generate our strong buy recommendations or our sell recommendations, what I refer to as the directional recommendation, as well as the investment characteristics of value, growth, and profitability. So every day we're taking a look at each company's balance sheets, income statements, cash flow statements, hundreds of financial metrics, and we take those data points for each company and we compare it to other companies in the sector. So we separate the strong from the weak, and we rank each individual company on every metric, and then we sort of total it up. So it gives us an amazing, powerful tool to be able to assess every company almost on a real-time basis every day. So if you have a research report that's written by an analyst that's 2 months old, I would never be able to look at a report that's 2 months ago. It's like looking at a newspaper article from 2 months ago and trying to make an investment decision. Quant updates every single day, so I know I have fresh data at my fingertips. And that's why I really like Quant, and I've been doing it for a while. And we have pretty strong results as well. This is a graph that shows the performance of all our strong buys, updated every single day going back 5 years. And we compare it to Wall Street strong buys and to the S&P 500. This gets refreshed every single day. And you can see going back 5 years, the performance for the quant strong buys is up 203% compared to Wall Street analyst strong buys up only 17%. And the S&P 500 up 67%. So by focusing on these core characteristics, what we do is we're looking for companies that are collectively strong on growth, valuation, profitability. And by identifying the companies that are strong on those metrics, we have a number of strong buys. And then this shows the record of all the strong buys. So really, this is not an ETF, or it's not a mutual fund. But what we're trying to do here is showcase how this strategy works. And as you can see, it works quite well. And you can use this strategy for selecting individual stocks or groups of stocks. So
Steve,
how does that?
Can I ask a question? When we posted your top 10 stocks for this year, one of the commenters said when the high quant grades are only momentum and revisions, that's when they don't trust necessarily the strong buy. What would you say about using the various factors in concert with each other?
Well, part of the strength is using multiple factors. There are definitely quant models that are focused just on momentum or just on growth. I think the power of the model that we have at Seeking Alpha is it's diversified in the base of factors that it looks at. So we're looking at both value, we're looking at growth, value, profitability, momentum, and EPS revision. So we're not reliant on just one factor. There's also a fair amount of diversification in terms of sectors and market cap as well that falls within the model that we have. So I think that diversification helps. If I saw like every grade was an F and momentum was an A plus, I would agree with that person. Like I would avoid a stock that was just strong on that only one factor. So the beauty of our system is we're looking for companies that are collectively strong across a number of factors. So I'm going to get into our top 10 AI stocks and how I pick them. I am not an AI expert, so I want to start by saying that right in the beginning, but I am relying on AI experts to pick these stocks. So what we have done is we've gone to the 4 largest AI robotic ETFs, and we've uploaded the ticker symbols from those ETFs into our Seeking Alpha quant system. So I'm letting professional managers vet the process who can ensure that the companies that are within our ETF basket are aligned with an AI theme. And I feel very comfortable by using the 4 largest ETFs that focus on that. So we then run those companies through the Seeking Alpha quant system, where we look for companies that are collectively strong on the factors that I mentioned. And that is how we pick the strongest AI stocks. And I think often you'll find that the stocks that we're focusing on are very different. If you go into those ETFs, you'll see the top 10 stocks in those ETFs are typically very different than what we're recommending as a strong buy. But it's great that we have the universe of stocks that have been vetted by them to select AI stocks that are AI stocks. So when we use our process to select our top 10 AI stocks, we are seeing tremendous growth in the ones that we're selecting. So by comparison, if you look at forward revenue growth estimates, and as I mentioned earlier, when we look at forward growth estimates, we're taking consensus, Wall Street consensus estimates from usually revenues and earnings, and that's exactly what we're showing here. So our top 10 AI stocks have a forward revenue growth rate on average of 38% and a forward earnings per share growth rate of 99%. And when you compare that to the S&P 500, the S&P 500 only has a revenue growth rate of 6% and an EPS growth rate of 10.6%. So the growth rate for these top 10 AI stocks completely crushes the S&P 500, but it also crushes the Mag 7 stocks. The Mag 7 stocks on average have a 17% revenue growth rate and a 20% EPS growth rate. So the stocks that we have selected are far, far stronger in terms of both their top and bottom line earnings. So I'm going to go through the picks actually fairly quickly, and then I'll show a slide that shows all of them together, so people will be able to monitor that. And this is obviously recorded, so they get to hit pause when they get to those pages. But our first pick is Lumentum Holdings, ticker symbol LITE. You're going to see a common thread. These are mostly in the IT sector. There's a variation of industries, but there are a couple of stocks that actually are not in IT, and I will highlight this. Lumentum Holdings is in the IT sector, and within communications equipment, it ranks 1 out of 38. The stock is up 402% in the last year, but I will highlight, if you look at the valuation, it is a little bit more expensive. If you look on the far right side at a D plus grade. Now, these are all sector relative. So this means where's the valuation or growth or profitability compared to the sector? It is a little bit expensive compared to the sector, definitely a bit more expensive than it was 6 months ago, but the growth is an A plus on this stock. So it is growing far faster than the rest of the sector. If you look at the long-term growth rate, a 3 to 5 year CAGR, it is at 61% compared to the sector at only 16%. And its forward operating cash flow growth is 203% versus the sector at a mere 14%. Now, even though the valuation grade is a D plus, we have a number of different valuation metrics that we look at. One of my favorite is PEG, and the PEG at this is at 1.1 times. So it actually puts it at a 30% discount to the sector on PEG. PEG, if you're not familiar with it, it's a great metric because it combines PE together with the growth rate of a company. So it gives more of a holistic picture encompassing the company's growth and value into one metric. Our second stock, Micron Technology, ticker symbol MU. I think what's interesting about Micron is if you look at the factor grades, the stock, the valuation is actually a B minus now versus 6 months ago, it was a C plus. So the valuation is actually more attractive now than it was 6 months ago. The growth rate is still an A plus. And in the last 52 weeks, the stock is up 387%. So despite that incredible rise in the stock, the valuation is actually better now than it was 6 months ago. If you're not familiar with Micron Technology, they are a global leading producer of memory and storage solutions, specializing in DRAM and NAND. So a lot of people are very familiar with this stock, and it was a stock that was in our top 10 as well for 2026. In terms of the company's growth rate, the long-term CAGR for 3 to 5 years out is at 51%, again, compared to the sector at just 16%. And the ROE growth, not the ROE itself, but the forward ROE growth for this stock is a whopping 182% compared to the sector at a mere 2%. Stock number 3 is Ciena, ticker symbol CIEN. This is in the communications equipment sector as well. This one ranks 2 out of 38. Valuation, as you can see on the right, is really at the same place it was almost 6 months ago, despite the stock being up 215%. Growth at an A minus is far stronger than the sector. I will say the profitability has notched up on this company. Profitability grade now is a B versus 6 months ago being a C plus. So it's actually more profitable than it was 6 months ago. But analysts really like this company now, where 6 months ago they did not. So when you look at the EPS revision grade, you can see it's an A minus. 6 months ago it was actually an F. So 6 months ago, that means analysts were taking their estimates down for the company. I guess they got that wrong. Our quant system did eventually get it right. So you can see when the quant went to a strong buy back in around October of 2025. And it has been a stellar performer, but analysts absolutely positive on the company now compared to 6 months ago. The long-term EPS growth CAGR is at 44% for this company, and its forward ROE growth is 45%. So a company not in the IT sector, General Motors. This company is obviously in the automobile manufacturing industry, where it ranks 1 out of 29. Over the last year, the stock is up 76%. And the valuation is actually really attractive. It's got a nice valuation framework. The valuation grade is a B minus now. 6 months ago, it was a B. But what really stands out to me here, if you look at the factor grades, you can see the growth for General Motors now compared to the consumer discretionary sector. It has an A minus grade compared to 6 months ago where it was D plus. So the growth picture has really turned around for General Motors. And you can see it in the analyst revisions as well. That grade is a B plus now compared to 6 months ago when it was a C plus. So General Motors, using a lot of AI, mostly to enhance their in-vehicle connectivity and their hands-free driving, which we're seeing with more and more automotive companies. But General Motors really sort of leading the way there, and it's been very helpful for the company. Stock number 5, another semiconductor company, is Taiwan Semiconductor Manufacturing. This ranks number 2 out of 69 in the industry. This stock is up 71% in the last year. The valuation, pretty much the same, D plus from a C, hasn't really changed that much, but the company basically straight A's across growth, profitability, momentum, and revisions. Long-term growth rate is 30%. EBITDA margin is 69% versus the sector at just 11%. And if we look at that PEG ratio, despite the valuation grade being a D plus, on a PEG basis is a 51% discount to the sector. So very, very attractive from a PEG valuation. Stock number 6 is Hut 8 Corp, ticker symbol HUT. This is one of the smaller companies, but still large at $6 billion. This is an application software. Stock ranks number 1 out of 176. The stock is up 160% in the last 52 weeks. But despite that, you can see the valuation is actually far more attractive now than it was 6 months ago. So it's got a B minus now versus 6 months ago at a D. The growth has slowed up a little bit, but what has picked up a lot is the profitability. So you can see the profitability grade is an A plus, where 6 months ago it was a D minus. So some of that growth now moving into the profitability, which is always nice to see. And I think with Hut 8 in particular, we've actually had periods where they've had negative earnings, and those negative earnings are now becoming positive earnings. So that is a really good sign for the company. Stock number 7, Celestica, ticker symbol CLS. So this has been a major winner for Alpha Picks. Currently in electronic manufacturing, it ranks 2 out of 18. And again, another stock that's up tremendously, but the valuation grade is a C plus now, a full grade better than where it was 6 months ago at D plus. You have an A for growth, B for profitability. The revisions have slowed down a little bit, but analysts still very positive. And every quarter, this company really crushes it in terms of their earnings results. So both top line and bottom line looking very strong over the last couple of quarters. They have a long-term growth rate of 43%, and they have an EBIT growth rate of 65% compared to the sector at just 14.3%. Stock number 8, Credo Technology, which has been getting crushed this year. We have had a strong buy on it. We've had a strong buy going back for a long time. This has been a terrific performer for the Alpha Picks portfolio, but as of late, the stock has really gotten hammered. And really, all I could say is this is sort of a high beta stock in the AI area specifically. This company is a developer of specialized microchips, which power connectivity for AI infrastructure, cloud computing, and hyperscale networks. So it's very much a high beta company. And it tends, when the market comes off for AI stocks, it comes off harder and faster. But when the market looks good for AI stocks, it outperforms all others. We can see the valuation grade now is a C minus. It's actually improved dramatically from where it was 6 months ago. And you can see really going back 6 months ago, it had that hold where you see in yellow. But now that the stock has come off, the valuation framework has improved as it does. The price comes down. If earnings stay the same, it becomes more attractive from a valuation standpoint. The growth is still A plus for this company. Profitability is actually stronger than it was. It's at a B now versus C minus 6 months ago. And analyst revisions have improved to an A plus. So this is a stock I think people should really take advantage of on the dip here.
Steve, we had Hanging by a Thread asked a question on the webinar replay that we posted about Credo. He's asking about the insider selling specifically from the CEO. What would you say to that?
I'd say more often than not. One I could say, actually, we have back tested insider trading and the C plus suite selling off shares, it is not an indicator of what happens with the stock. And I think investors have to know, for individuals that work a company and receive stock, it's a form of compensation. It's not necessarily an investment that they're making. They get shares of a company as part of their pay package. And when they want to get paid, often they will have a scheduled exercise for selling shares. And if you're a CEO who has not been paid a lot and you have a tremendous amount of your assets in the shares, if you want to buy a house or if you want to send your kids to school, this is really the most common thing that I see over and over again. When there's insiders selling at a CFO or CEO level, there's usually a purchase that they want to make, or they haven't really made a lot of money in terms of the salary. So I would say that's a very poor sign to use. Conversely, though, I will say when you see a number of like C-level executives buying the stock, usually in unison with each other, they tend to know that something's going on, and that is a positive indicator as a factor. But the selling is not a good factor because so many of them tend to need to get paid, and they use their options or their shares for that payday. So it's not like an investment as an investor makes. If you're a portfolio manager or an individual investor, you're buying shares and hoping for a good return. If you're an employee of the company, that's your compensation. So historically, that is not a good sign. But as I mentioned before, this is really a high beta stock within AI. So it tends to have dramatic moves in either direction. And what I will say now is if I look at the earnings for the company, over the last 90 days, 12 analysts have taken their earnings estimates up, 0 have taken it down, and that's for the fiscal year. And for the upcoming quarter, which will be released on March 4th, 12 analysts have taken their earnings estimates up for the upcoming quarter, and 0 have taken it down. I think that's a really powerful sign from people that are experts in these stocks, saying that they believe the earnings will be better than expected. And if we scroll down, we can actually look at this company going back almost like 12 quarters, more than that, like 20 quarters. They've beat almost every time except one quarter they missed by a penny. There's been a couple where they've been flat in terms of reporting, but for the majority of quarters, and we've had 1, 2, 3, 4, 5 quarters in a row where they have beat expectations on both the top and bottom line basis. And what's really cool about this picture is that if you go back to like the fourth quarter, or go back to the second quarter of 2024, their EPS was a penny. Quarter after that, 4 cents, 7 cents, going up to 7 cents, 25 cents, 35 cents, 52 cents, 67 cents. This company is in the freaking sweet spot right now. So their earnings per share is going up by leaps and bounds, as well as the revenue. And as I said, it's a high beta stock for AI, but the company is making money and every quarter gets better and better. So I would definitely use this pullback. And it's had a huge pullback in the last month. It's down 28%. And the valuation picture is actually better now than it was 6 months ago. If we look at growth, that's almost an A plus report card. Revenue growth is an A plus. Revenue growth forward is 105% compared to the sector at 8.7%. If we look at EPS forward growth rate, it's 248% compared to the sector at 14%. So I'm loving the pullback on this stock right here. I would definitely take advantage of it. And I will stop sharing this slide and go back to our presentation. So that is Credo. And stock number 9, AppLovin. You might be familiar with that stock. That's been at Alpha Picks for quite a while. That stock is up almost 1,000% within Alpha Picks. The 1-year return on it is up 31%. Valuation framework is the same now as it was 6 months ago. Growth is an A+, profitability is an A+. This is an application software. It ranks 8 out of 176 stocks. The long-term growth rate is 48%, and the forward ROE growth rate is 93%. And last but not least, we have Globus Medical. So this finally gets us outside of the IT sector. This is healthcare equipment, where it ranks 4 out of 124. You can see the valuation is in line with the rest of the healthcare sector, but the growth has improved to B+ from C+. And you can see the analyst revisions has improved to A+ from D-. This company has a forward EPS growth rate of 22%, and its EBIT growth rate is 68% compared to the sector at 10%. So that is our list of stocks. Here's a picture of all of them. And you can see for the most part, if you're looking at profitability, growth, or momentum, or EPS revisions, all those grades are in the green. And basically, those grades are there to give you an instant characterization of how the company looks on that metric compared to the sector. So always keep in mind those grades are sector relative, but I do looking at where they were 6 months ago, or we even can show you the 5-year average as well for the absolute data points. But the point of the grade is to give you that instant characterization, so you don't have to do a lot of work to find out where they are in terms of their growth or value versus the sector. Rita, let me open it up to questions.
I appreciate that. First of all, really appreciate the context. We love context here. First of all, what is your personal disclosure here, if you would care to share?
Yeah, no, actually, like last year, I bought the top stocks about 2 weeks after I announced them. Like, I don't really want to be front running or accused of it, so I usually wait. We announced our top stocks for January 26th. I think it was around January 6th or something like that, but I actually haven't bought them yet. So I need to get on that.
Because I thought you were waiting a couple weeks last time we talked. I thought that
I do usually wait a couple weeks, and I'm glad I did because the market's getting rocked here. So
and
early January the stocks did really well, so I would have been chasing them right away. And I'm kind of glad I waited because like I said, it's deja vu. It's like last year the stocks started to fall off sharply at the end of January and beginning of February, and we're finding the same thing. So this is the point for me to buy these stocks.
You love to buy the dip, and
I do love
anyone else to do so.
Yeah.
And the other thing I would ask, we have Alphabet reporting after the close today. We have Amazon reporting tomorrow. I know that they weren't part of the list today, but anything that you would offer that you're picking up from earnings? We've seen some major players in the tech space report, and or if you don't have anything to say about that, anything else that you would add about these picks and keeping your wits about you as they slide?
I'd say in terms of the companies reporting earnings or any of the companies in the S&P 500 or technology, I really like the list of stocks that I showed you here today. Mostly because like the EPS growth rate on average for these stocks is 99%. That is huge. And the top line was, let me go back to that slide. Yeah. Top line growth is 38%. EPS growth rate is 99%. You're not seeing that at the Mag 7 stocks usually gain all the attention when they report because people like to say it's an indicator of how the market's going to do going forward. We've seen NVIDIA do well. We've seen a couple of the other companies do well. I think is it Amazon or Alphabet that reports today?
Alphabet reports today after the close, and Amazon reports tomorrow, Thursday.
All right, let's see what we're saying here. So currently we have a hold on Alphabet. Hold does not mean sell. And we can see why. It's because the valuation is an F. If I click on valuation for Google, you can see it is a lot of red. That is not a good report card. The one area where the valuation is fair would be the PEG ratio, which combines PE with the growth rate. That's a C minus at 0.97. It's still a premium to the rest of the sector. So yeah, the stocks that I showed you today have a much better valuation framework than we see on Google. And if we look at the growth, we're seeing pretty good growth, but like EPS forward growth rate is 24% compared to that basket of 10 stocks that I showed you. It has that 99% growth rate. So the growth for those stocks overall far higher. The forward revenue growth rate is 14% for Google. And as I showed you for the basket of stocks at 38%. So if I'm looking at technology, I can find stocks that have much better top and bottom line growth.
Much appreciated. Thank you for taking that extra time. Steve, how can people find more from you more of the time? Any way to do that?
So perfect segue. I just happened to end up on Beyond AI stocks as you were saying that. Obviously, I produce quite a few articles, so I'd say definitely follow the articles. But if you don't want to just rely on like the top 10 picks for the beginning of the year, I have two products that I created. One is Alpha Picks, and the other is PQP. Alpha Picks, if you join Alpha Picks, it's a separate product than Premium. Alpha Pix runs about $499 for the year. And what we do is we send you our top 2 quant strong buys every month. So you're not getting a lot of ideas thrown at you, but you are getting our best ideas twice a month. Typically, on any given month, there might be 2 to 3 trades. So that third trade could be a stock that we're selling out of the portfolio. Alpha Pix has had an excellent return, as you can see in the last year. It's up 45% versus the S&P up 15% for the same period. It is designed for long-term investors, and we try to keep it fairly safe with the stocks. Alpha Pix selects U.S. common stocks or ADRs that are primarily listed in the U.S., so they're usually major ADRs. Market cap is above 500 million, and we don't look at stocks for Alpha Pix that are below $10 a share. So fairly conservative, quite a few parameters and criteria, but the performance has been great on Alpha Pix. We did a survey for Alpha Pix customers, what they wanted more of, and they wanted more ideas. So I created another product called the Pro Quant Portfolio, and we launched that last June. And that is an even portfolio of 30 equally weighted stocks, but we rebalance it on a weekly basis. So on average, every week, you're getting 2 to 3 ideas where you buy and where you sell. It does not have as many restrictions as Alpha Pix. So there is no market cap restriction. It's investing in stocks all over the world using ADRs. And as I said, each week there's usually 2 to 3 trades as opposed to Alpha Pix where you get that for the entire month. Performance has been great. As I said, we launched it in June of last year. The performance since June is up 43% compared to the S&P 500 on an equal weighted basis, up 12%. And if I were to show you some of the numbers, if we went to Alpha Pix, then I will show you that actually. Let's see if we go to Alpha Pix, and I'm going to share this tab instead. And we look at performance. And I'll show you the returns on some of the top stocks there. So you can see AppLovin is up 1,500%. Celestica up 1,166%. Super Microcomputer, which we sold out of, up 968%. Pal Industries was up huge over the last 2 days. We've had tremendous returns. Since inception, Alpha Pix is up 286% versus the S&P up 82% for the same period. And even year to date, it's a pretty good picture. It's up about 5.5% compared to the S&P, up 1.1%. If we were to look at PQP,
do you have to be an Alpha Pix subscriber to view that page?
You do. So there's a little sneak preview. And for the Pro Quant portfolio, if we look at the performance here, and you will see since inception up 40% year to date, it's up 12.83%. So a little quick picture on some of the stocks there as well. It gives you an idea of where we've been. And hopefully those will be of interest. So if you don't want to get articles that are just for our top 10 stocks for 2026 or our top AI stocks, that's a more consistent way to approach it. And really that wealth creation comes from being a disciplined investor. So regardless of what's happening in the market, whether it's rallying or there's a major correction, buying month in and month out creates tremendous wealth over time. And that's really the way to take advantage of the stock market and have it work to your benefit.
Steve, always appreciate talking to you. I know our audience always appreciates your picks and your insights that go along with them. So thank you for taking the time. Thanks for sharing so much with us. And thanks for giving us so many opportunities to make a profit and to find that alpha that we're all seeking.
My pleasure. Have a great day, and thank you for your time today.